On slide 21, shifting gears to our crowding analysis. Houston, we still have a problem with the Spoos, and that's what I mean. We're still here in the correction probable quadrant. That just indicated by a deep implied volatility discount on the y-axis and negative skew or depressed skew relative to the trailing 1 year sample on the x-axis, and so that's a terrible setup heading into next week. I'll reiterate, that's a terrible setup heading into next week, and it's even worse for the Qs here. So doesn't mean the market has to crash next week or something like that, but this is definitely not a market that looks anything like the market we saw post the March FOMC heading into that OPEX, and it's just not the same. The fundamentals are even worse in my opinion. That FOMC press conference, which was briefly celebrated because Powell did some things to take out the immediate term hawkish right tail for monetary policy. But then I think he put it back on with a lot of what he said in terms of being willing to take rates past neutral, especially that I thought was particularly powerful. And I think part of the reason the markets have struggled since then is a function of everyone kind of getting to where we've been for several months, which is this is a Fed that is just losing the battle on the inflation front, losing the battle on the credibility front, and it's just going to have to do more sooner and cause more pain than I think the average investor realizes, or certainly the average investor who is still anchoring on the prior Federal Reserve reaction function regime. Certainly their portfolios, their exposures in the portfolios might be anchoring on that prior regime, as we continue to see the bloodbath in the NASDAQ and related digital economy names that very fortuitously we got you out of many months ago.